Dear students, in this section we will take another case study on dividend. The theoretical aspect of dividend has been discussed in Unit 3. In this section, we will take up an example to apply those provisions which we have already discussed. I have given an example on the dividend, the corporate dividend, the intercorporate dividend. Suppose the problem is coming on your screen. You can see that the Blue Bird company is a domestic company and it furnishes certain items, that is the business income without considering the following dividend, 25,50,000. Dividend received from A Limited, a domestic company, dividend received from B Limited, an Indian company, for rupees 4 lakhs. Dividend received from C Limited, incorporated in UK, and Blue Bird Limited held 32% of share capital. Dividend received from D Limited, incorporated in France, and Blue Bird Limited held 20% of share capital. Expenses incurred to earn the dividend from D Limited, rupees 45,000, and expenses incurred to earn the dividend from C Limited, 25,000. So, if you go into detail of this problem, you can find that there are two companies which were incorporated outside India. That is, company C Limited has been incorporated in UK and company D Limited is incorporated in France. So, both the companies are foreign company. In this case, you have to consider the provision of section 115 BBD. Now, let us see what the provision says. 115 BBD says that in case of foreign company means which is established or incorporated outside India. In this example, we have two foreign companies. One is C Limited and second one is the D Limited. So, 115 BBD will be applicable. What the provision says? As per section 115 BBD, the dividend received from a specified foreign company to be taxed at a special rate of 15%. So, I am giving the stress on specified foreign company. What does it mean by specified foreign? We know the foreign company is, what is the foreign company? But what is specified foreign company? Specified foreign company means a foreign company in which the Indian company holds 26% or more in the nominal value of the share capital. This is the primary condition. Whenever a foreign dividend is involved, you have to check whether the dividend is being received from such company. Such company means whether it is a specified foreign company. If it is a specified foreign company, the dividend received from such company will be taxed at the rate of 15%. How do you judge whether it is a specified foreign company or not? You have to check the shareholding, percentage of shareholding. It should be 26% or more. In the given situation, in the given instance, there are two foreign companies, C Limited and D Limited, and specifically the information is given here. In case of C Limited, the Blue Bird Limited holds 32%, but in case of D Limited, the Blue Bird Limited company holds 21%. So, what will happen? 115 BBD will be applicable in case of C Limited because it is a specified foreign company. Here you have to check again, in case of specified foreign company, no deduction in respect of expenditure or allowance will be allowed in respect of dividend received specified foreign company. So, you have to keep in mind two things, 2 points. One, you have to check whether it is a specified foreign company or not. If it is a foreign specified company, the dividend received from such company will be taxed at the rate of 15%, and in respect of such dividend, no expenditure or allowance will be deducted. So, 2 points to be remembered. So, now we may proceed for the computation of tax, and any other case, the amount, that is the total income, to be taxed at the rate of 30%. So, where provision of section 115 BBD is involved, there would be two components of tax liability. One is 15% tax to be paid on the dividend received from the specified foreign company, and 30% on the remaining dividend. So, this is the provision. We will apply this provision in this particular problem, in this particular case. Now, we may proceed to solve this problem. Now, computation of tax liability. So, business income is given. Now, what would happen in case of dividend? Dividend received from A Limited and B Limited is nil, because these are exempted under section 10 subsection 34. In India, the dividend in the hands of the recipient is exempted under section 1034. Then dividend from C Limited, 5,25,000, and in this case the Blue Bar company has paid an expenditure. Now, as per provision of section 115 BBD, no expenditure to be allowed as deduction, but the dividend from such specified foreign company will be taxed at separate rate. But you have to calculate the total income. So, first compute the total income. Now, dividend from C Limited and dividend from D Limited. D Limited is not the specified foreign company, because the shareholding is less than the 26%. Okay. So, dividend from D Limited, the amount of expenditure may be deducted or should be deducted, and you will get the total income. Now, I have already told you that there are two components of tax liability. One, the tax at the rate of 15% on the dividend received from the specified foreign company, and then you have to apply 30% tax rate on the remaining income. Here, tax on 5,25,000 at the rate of 15% under section 115 BBD, and then the tax on balance income at the rate of 30%, and then the secondary and higher education cess has been added at the rate of 3%. So, this is the amount which will be paid by the company. So, in this way you will calculate the tax liability of the company who receives the dividend from domestic company or Indian company and from the foreign company. Foreign company, there are two types of foreign company. One is normal foreign company and another is specified foreign company. So, you have to consider the provisions in your mind. Thank you.